Can you just tell me what happened, kind of how the last year's been, how are you now, and kind of how you're set up going forward?
Yeah, I mean, obviously we'd had some issues with some direct investments and some, regular emerging market issues. We're heading into the beginning of the pandemic last year with a number of sovereign restructurings on the horizon that I think really played to our strengths, and we were having quite a good run, and all of a sudden, somebody hit the brakes on the world, and I think in many ways the emerging markets had the same kind of played out the same sort of way that U.S. high yield. But in the case of U.S. high yield, we're almost, the Fed was basically picking winners and losers. It was a less formal process, but you had the same kind of dynamic in the emerging markets where sort of countries with market access were able to issue, and they have in, quite large numbers, to be able to fund the bridge to, over the pandemic. The countries that were a little less stable or had other issues, whether it be Argentina, certainly Venezuela, Ecuador, most of Africa, have had to implement a bunch of different measures, either going to their creditors and asking for an extension of terms or working with the official sector. And therefore, you've had this sort of bifurcation of the market where many of the countries have been able to fund through the pandemic, and a number of the places, especially the kind of places that we've done business, and I think that other asset managers have run into some trouble, have had to scramble, and we're dealing with a very rapidly shifting landscape. So my sense is that as things normalize, things will play out quite well. But obviously, I think each company, if they're under some stress, needs to look at what appropriate cost reductions need to be implemented.
So Hans, good morning. It's Guy. So what next?
Hey Guy, how are you?
I'm good.
What next? Let's get through this little. We were somewhat surprised. We thought this was a bit of a, technical filing, and I guess one of your intrepid bankruptcy reporters hopped on the news, so we weren't able to sort of deliver the message the way we intended. But I think it's just going to be. I mean, obviously, Manhattan real estate is an interesting thing. I think they had a 30-year bull run after a couple decades, or 30-year bear run, going from sort of the 70s to the mid 90s. Just the idea of having the overhead of prime Manhattan real estate makes little sense, especially in this environment, and put some strains on our cost revenue. So I think it's just a matter of making sure we have the team intact, that we have the right personnel to deploy for pursuing the opportunities that our investors want us to pursue and take advantage of them. And right now, I mean, the pandemic has created sort of an optimal investment opportunity if you have the time to play it out the way we have in the past. I mean, I can go through, if you look at the sort of the timeline on extracting the value that Greece had, where, at the worst case, it was 13 cents in the dollar and then went sideways for a number of years before now trading above par. We need to have that kind of ability to ride through to provide the value for investors and make sure that we keep the right personnel on payroll.